Thank you for joining us. I'm Christine Jacobs-Sandejas. For the first time in over 3 years, the Bangko Sentral ng Pilipinas raised interest rates from 3% to 3.25% last May 10. The central bank says this should help temper rising prices of basic goods and commodities and prevent the peso from further depreciating against the dollar and other foreign currencies. Also, economic managers warn that high prices will continue for the rest of the year. And to help us understand this, we have CNN Philippines business analyst Mike Alimurung. Good morning, Mike. How are you?
Good, thanks, Christine.
And what should people keep in mind now that interest rates are going up?
First thing to understand is why the BSP is raising interest rates. There's two things really. One is it's trying to decrease the supply of money available and therefore really encourage people to not spend as much perhaps. In doing that, you raise interest rates, that reduces supply, hopefully to manage a little bit inflation. The second reason why they're doing that is really to strengthen the peso. So one of the things that's happening here is that you're trying to make the BSP is trying to make the peso more attractive to foreign investors by increasing the interest rates. It does that. So as a result of that, we could expect that hopefully prices become more manageable. Cost of borrowing does go up when you raise interest rates. Stock prices generally may go down as a result when you have higher interest rates, cost of production increases. Therefore, companies spend less on investment, they discourage investment, and therefore perhaps the returns are not as good, and therefore people have less disposable income as a result. So that's one of the things that could happen. The cost of goods may hopefully get more managed as we do this.
And Mike, so with that said, do you have any tips on those who are amortizing cars or housing loans? And in your opinion, is it advisable to take out a new loan at this time?
Right. So one of the effects of raising interest rates is housing loans and car loans get more expensive. One thing to understand is if you happen to have a car loan today, that should be okay if you are on a fixed interest rate. So however, if your interest rate is more variable, then of course it would rise, your debt payments would go up as interest rates go up. On the other hand, one thing we have to understand is that the interest rates, while it has gone up on 3.25%, historically is not that high. Even just as recently as perhaps 10 years ago, we were looking at something like 6%. And therefore, it's something for us to be aware of, be more conscientious about, but it's not something that we should say don't get a car loan or don't get an amortization. I mean, if you have disposable income to do so, then yes, perhaps you should still do so. There is an idea that perhaps interest rates will go up further because provided the inflation continues to remain relatively high, a BSP may look at finding a way to continue to manage it. So there is that thing that you have to keep in mind as well.
Okay, with that said, Mike, the country's economic managers also say the rising cost of fuel is actually one of the triggers for the high prices. Now, how should these influence consumer spending?
Right. I mean, it's definitely a trigger. High fuel costs contributes to a lot of factors. And one in transportation, shipping, it makes costs of goods and production more expensive. I think one of the things that we have to be aware of then is fuel costs and transportation are essentials, and people have to do that. And so one of the things we can do is be more conscientious on where we spend disposable income. I mean, if you have to get to work, you're going to have to get to work, and fuel costs are one factor for that. Transportation costs will go up. Therefore, you need to be more conscientious on how you spend perhaps your disposable income for things that are less essential.
And lastly, Mike, what's the market outlook for this week? Can we expect actually a better performance?
Well, that's an interesting question, really. So if we have to understand, last week the PSE, or Philippine Stock Exchange Index, did go down at the end of the week, very slightly from Thursday to Friday, 21.84 points. One thing to understand, though, is that relative to where it ended or where it was the week before, it's largely unchanged. On the other hand, we can say that provided that inflation continues to remain a concern and the prospect of BSP raising interest rates remains a possibility, the market will probably remain a little more muted and therefore perhaps largely unchanged as well this week. What would really be any triggers is any sort of news that comes out that continued strong growth, for example, could be a catalyst. I think that's what people are looking for, some reason to invest in the stock. And the lag between BSP's action, raising interest rates, there is going to be some delay. It's not like you're going to raise interest rates and suddenly you'll have all these effects right away. There's going to be some delay before anything really takes effect, usually 6 to 12 months before you see the real impact of what BSP's action is.
Okay, well, thank you so much. That was Mike Alimurung, CNN Philippines business analyst.